The less money you have, the more money credit card companies make off you. That's not an accident. That's the business model. In 2023, American credit card companies collected over $130 billion in interest and fees, not from wealthy customers, from the 40% of cardholders who carry a balance. People who can't quite pay off what they owe at the end of the month. And here's what makes this system genius and ruthless at the same time. It's designed specifically to find those people, keep them in debt, and extract maximum value before they figure out what's happening. Stay with me, because by the end of this video, you'll never look at a credit card offer the same way again. Credit cards as we know them didn't always exist. For most of history, if you wanted to buy something you couldn't afford, you either saved up or took out a formal loan. Banks had to assess your risk. There was paperwork. There were collateral requirements. It was slow. In 1958, Bank of America changed that forever. They mailed out 60,000 pre-approved credit cards to residents of Fresno, California. No applications, no interviews. Just, here's a card, go spend money. It was called the Bank AmeriCard. You probably know it today as Visa. The idea was simple. Merchants would pay a small fee every time a customer used the card, and the bank would make a little money on every transaction. Clean, low risk, everyone wins. Except that's not the part that made credit cards one of the most profitable financial products ever invented. The real money was in what happened when customers didn't pay their balance in full at the end of the month. When they revolved their balance to the next month and got charged interest, that's where everything changed. Because if you carry a balance at 24% annual interest and you're only making minimum payments, it can take you over a decade to pay off a $5,000 charge. During that decade, the bank makes more from you in interest than you ever spent in the first place. Here's an experiment. Get out your credit card statement right now. Find the minimum payment due, and then find the tiny, almost hidden line that says, if you only make minimum payments, you will pay off this balance in... Most people have never read that line, because credit card companies don't exactly put it in a 72-point font. Here's how the math works. Say you have $3,000 on a credit card at 22% APR. Your minimum payment is 2% of your balance, so about $60 a month to start. If you only ever pay the minimum, you will take 22 years to pay that off. You'll pay $3,800 in interest alone on a $3,000 debt. The minimum payment isn't designed to help you get out of debt. It's designed to keep you in debt for as long as possible. In fact, the minimum payment formula was deliberately lowered in the 1980s. Card companies lobbied to reduce minimum payments from 5% of the balance to 2%, sometimes even lower. Less money paid each month means more time in debt, means more interest collected. The Federal Reserve actually studied this. They found that reducing minimum payments causes borrowers to repay their balances up to 50% slower, which is obviously a coincidence, and the credit card companies definitely didn't intend that. So far, this sounds like a system that just traps people who are bad with money, but it's actually much more targeted than that. Credit card companies use incredibly sophisticated models to identify customers who are almost financially stable, not completely broke. Broke people don't get approved, but people who are stretching, people who carry small balances, people whose income just barely outpaces their spending. These are the most profitable customers in the entire portfolio. They spend enough to generate transaction fees. They carry just enough balance to generate interest, and they almost always make at least the minimum payment, keeping the account current and the cash flowing. The credit card industry calls them revolvers, and every major card issuer has a dedicated team working out how to attract more of them. The marketing follows. Rewards programs are designed specifically to encourage more spending. Cashback on every purchase sounds like the bank paying you, but the interchange fees merchants pay cover the rewards and then some. The bank wins on both ends, and for customers who look like they might be able to carry a balance, the interest rate offer is often higher because statistically they're more likely to revolve. None of this means you should cut up your credit cards. Used correctly, Credit cards are genuinely one of the best financial tools available. The rewards programs alone can be worth hundreds of dollars a year if you pay your balance in full every month. The key phrase is every month. If you carry no balance, you pay no interest. The bank makes their 1.5 to 3% from the merchant on every transaction, and you get a fraction of that back in rewards. You're essentially using the bank's money for free for 30 days. The system is only extractive if you let it revolve. 3 things worth knowing. 1. Pay the full statement balance, not just the minimum every single month. Set up auto pay for the full amount. 2. If you already carry a balance, the fastest way out is to find a 0% balance transfer card, move the debt across, and pay it off during the introductory period, usually 12 to 21 months. 3. If you're being charged penalty APR, sometimes as high as 29.99%, call and ask for a rate reduction. It works more often than you'd think. Banks would rather keep you at 20% than lose you entirely. The system is built against you, but now you know how it's built, and that's the first step to getting out. If this video made you rethink how you look at credit, do me a favor. Hit subscribe. We put out videos like this every week. Business stories, financial systems, the things you probably should have been taught but weren't. Next up, why your savings account is mathematically designed to make you poorer every year, and the accounts banks don't advertise that actually keep up with inflation. See you there. Word count, 1,320. Estimated read time, 9 min at 150 WPM voiceover pace.